Hey everyone, welcome to another case study breakdown where we help you control where your money goes. So in this video, we'll be breaking down the case of Katie and Rod, two Americans seeking the nomadic dream. Katie and Rod are US citizens living in California. They intend to leave the US and live a nomadic lifestyle or settle somewhere in South America. They have three companies in the US. Company A. Company A is a California C Corp with a current valuation of $30 million. It is owned by a trust and the directors are Katie and Rod. The company has a main office in California for assembly and shipping and employs 75 staff, all from the US. In addition to US employees, there are contractors from China and Serbia. The company's primary source of income is the sale of cosmetics, and it offers 6,000 products sourced from several hundred suppliers worldwide. Sales are conducted both online and directly to wholesale customers. The company has reduced its employee count to 75 after moving some of its fulfillment operations to Texas. It also uses a third-party shipping company in Texas and operates its own fulfillment center in Irvine. Katie and Rod plan to sell the business within the next 1 to 2 years and are seeking strategic tax advice. Next up, Company B. Company B is an LLC registered in California with Katie and Rod serving as directors. The company has no physical offices or employees, and its primary source of income is consulting fees. Most expenses are managed through this company, which invoices their other companies. Purchases are typically made online or over the phone. They are considering relocating this company overseas. And finally, Company C. Company C is a Delaware C Corp that holds 100 patents and specializes in licensing. They have developed a wooden wick and licensed it to Company A, as well as to two other US-based companies. The company is solely directed by Katie and has 5 other shareholders. They do not have physical offices and earn royalties from Massachusetts and California through the licensing of patents. The company conducts international licensing through US license contracts and has been involved in numerous legal battles due to patent infringements. Some of their patents are about 20 years old and have expired, and they do not believe the company is sellable. And here they are looking to reduce their tax liability. What do they need? The ultimate solution for Katie and Rod needs to include 1. Where should they have their consulting business relocated? So this is Company B. Number 2. Company C needs to reduce its tax burden should this company stay incorporated in Delaware. And number 3. How to optimize Company A and its tax situation or adjust the structure to optimize selling it in the next 1 to 2 years. Number 4. Possible residency options for Katie and Rod. And number 5. Possible second citizenship options. They're willing to invest in citizenship around $200,000 if needed. These factors need to be considered together because, for instance, it's not useful to select a jurisdiction for incorporating a company if it is a blacklisted country, or select a jurisdiction to relocate to if there's no practical residency program available. Now, the struggle of Americans. Katie and Rod are US citizens, but they are planning to travel to South America this year and then live and travel between several countries. Since they are US citizens, they will be subject to taxation on their global income. All US citizens and residents, including resident aliens and citizens living outside the US, are required to pay federal tax on their worldwide income. But that is not the only thing. Katie and Rod declare that they are not residents of the US, but things are not that simple. The US is a federation, meaning the country has both federal and state regulations, and each state has its own set of rules to determine residency for tax purposes. Now, Katie and Rod were residents of California. An individual can have multiple residencies but only one domicile. California considers a person who leaves the state without establishing a new domicile elsewhere as a California resident for tax purposes. Also, the state can still classify someone as a resident even if they maintain significant connections to California, such as maintaining a home, having a California driver's license, or voting in California elections. California uses a facts and circumstances test to determine resident status. If the facts and circumstances indicate your ties are greater to California than any other state or territory, you may be considered a resident. Basically, this is a center of vital interest test, which widens the net significantly. As such, if your main base of employment is in California or you own or operate a business in California, then you may be considered a California resident even if you're almost never physically in the state. Besides, California does not recognize the Foreign Earned Income Exclusion, FEIE for short. The FEIE allows US citizens and resident aliens to exclude a certain amount of their foreign earned income from federal taxable income. However, California still taxes this excluded income at the state level, creating a heavier tax burden for expats. Therefore, Katie and Rod should establish residency in a state that does not impose state income tax. Now, moving residency away from California. Some ways you can establish residency in a no income tax state and avoid ongoing state tax obligations while living abroad as a US expat are obtain a driver's license. So, to establish residency in a no income tax state, visit the Department of Motor Vehicles, DMV for short, in your chosen state to obtain a driver's license. Next, you can set up a mailing address. So establishing a mailing address in a non-income tax state is crucial. You can either rent a mailbox or use a physical address, such as that of a relative or a friend. Then you could register to vote. It is important to update your voter registration to reflect your new address in the no income tax state. This not only helps establish residency, but also ensures that you can exercise your right to vote in the state. Then you've also got a healthcare switch. So if you have doctors, dentists, and other healthcare providers in California, change the location of those doctors or medical providers to another state. And finally, cut ties with any social memberships if you have any in California. If you are unable to cancel the membership, at least retain proof that you tried to cancel such memberships. And also make sure to relocate any vehicles you have, such as cars, trucks, motorcycles, to your new state of residence where possible. Now, a good state to relocate your residency to is one of 9 US states that do not impose state income tax. So this is Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. Texas and Nevada would be the best choice as they have zero personal and corporate income taxes. So to be on the safe side, we advise Katie and Rod to establish connections with the US state that does not have income tax prior to their leave from the US. It could also be important for their companies because some of them are pass-through entities. If we move any of those companies to another state, but Katie and Rod are still considered California tax residents, that could affect the whole structure. Speaking of companies, we've now established our base case against which to compare other possible tax strategies. So for these purposes, we will assume that the base case involves a resident of a state with zero personal and zero corporate taxes. This basically means Nevada and Texas, because other places have either a personal tax or a corporate tax or both, but other options can be used. Now let's not forget, California also has rules for when a company incorporated in another state is considered to be doing business in California and is therefore a tax resident in California. Based on Katie and Rod's company structure, their main concern may be whether their companies will be considered to be doing business in California if they have California clients. If you can manage to keep all of your operations outside the US, including sales, you should be fine even if your customers are located in California. Now, what to actually do with Company A? Company A is a California C Corp held by a trust, and Katie and Rod intend to sell it in the next few years. This company should also be relocated from California. Since some of the work has already moved to Texas, Texas seems like a good choice. To achieve this, they will need to sever ties with California, including closing the office there. For further tax optimization, Company A should be able to qualify as QSBS. The QSBS tax exemption allows small business owners to potentially save a significant amount on capital gains. In general, investors can deduct up to $10 million in taxes or 10 times the adjusted cost basis, whichever is greater. If Company A qualifies as QSBS, Katie and Rod could potentially take advantage of the $30 million capital gains exclusion for themselves and their sons. QSBS could theoretically be gifted to an unlimited number of separate taxpayers, each of whom would have a separate $10 million cap and a 10x basis cap. It may be possible to create non-grantor trusts in states such as Delaware or Nevada, which would gift QSBS to a Delaware Incomplete Non-Grantor Trust, or DING Trust for short, or a Nevada Incomplete Gift Non-Grantor Trust, NING Trust for short. Trusts can also be a useful vehicle for asset protection planning. Katie and Rod could establish 2 non-grantor trusts for their sons, potentially allowing them to exclude all $30 million from capital gains when selling Company A. What to do with Company B and C? For companies B and C, we could use some sort of foreign strategy to outsource income abroad and reduce the US tax burden. They can use just one foreign company to optimize the tax burden of those 2 companies. We came up with 2 possible tax strategies. Katie and Rod's first option is to set up a foreign company in Labuan and have it owned by a US corporation. This would allow the foreign company to be taxed at reduced GILTI tax rates, or GILTI tax rates. They can also restructure Company C from an LLC into a C corporation, turning it into a holding company with no operational activities. The offshore company would then offer services to Company A and Company B. along with providing consulting services and charging fees for those services. They can outsource certain operations such as marketing from company B to the foreign company in order to receive payment for those services. Their aim with this is to keep $300,000 to $450,000 out of the reach of US taxes. This includes $100,000 to $200,000 in profits from company C, $200,000 to $250,000 from company B, and around $500,000 in personal earnings. So this together would be around $800,000 to $1 million in total. This strategy would require a comprehensive transfer pricing study, as transfer pricing rules come into play when related parties engage in cross-border transactions. To avoid foreign company service income rules, or FSCI rules, the best option would be to have a foreign company incorporated in a jurisdiction where Katie and Rod are residents. One possibility is to establish a company in Labuan, where Katie and Rod could then obtain a Labuan Director Visa, which is a 2-year renewable multiple entry visa. However, in this situation, Malaysia would tax Katie and Rod on their salary, which we want to avoid since we want them to be eligible for the foreign earned income exclusion on the US tax side. Perhaps it would be better to hire local employees in Labuan. They would need to meet local substance requirements such as having a physical office with a sufficient number of full-time employees in Labuan, as well as meeting annual operating expenditure requirements. However, the costs of maintaining local substance are relatively low since wages in Malaysia tend to be very low. Also, banking can be done through one of the major Singapore banks with a local presence. Now, what are the benefits of this first option? With this strategy, Katie and Rod could receive a $120,000 tax-exempt salary each through FEIE for a total of $240,000, while living in South America or living nomadically. In Labuan, there is a 3% tax for trading companies, so on the remaining $550,000 to $750,000, they would pay a 3% tax in Labuan, but they can get an 80% tax credit on tax paid towards GILTI tax. So they would end up with a 3% tax multiplied by an 80% tax credit against the GILTI tax, which would equal 11.1% total tax paid on a corporate level. After that, they would be able to take tax-free approximately $90,000 a year together in dividends from the US C Corp, and on the remaining amount of about $450,000 to $650,000, they would pay a 20% tax long-term capital gains rate on dividends. Additionally, Katie and Rod could avoid a 20% long-term capital gains rate tax on dividends if they don't distribute them. Instead, as they are interested in investing, they could, after paying a GILTI tax, distribute $90,000 and reinvest the amount above that under the company. Now, the drawbacks of this first option. They will be subject to GILTI tax, which would add up to 11.1% tax paid on the corporate level, including taxation in Labuan. Next, they will need to get a proper transfer pricing study for services that will be happening between the US companies and the offshore company. And finally, they will need to meet local substance requirements and actually hire locals to meet these requirements. So that brings us to the second option, also known as the better option. We prefer this option as it includes trusts as the best tax optimization strategy for US citizens. However, it's also worth understanding that trusts tend to cost around $20,000 to set up properly and around $10,000 a year or more to maintain, depending on what is needed. So the question becomes, would that pay off in Katie and Rod's case, considering the amount of income that should flow through the offshore company? If Katie and Rod were to add more companies or businesses to the trust structure or have more income coming from existing offshore companies, as they said they would endlessly start businesses because they are entrepreneurial at heart, these things could happen under one properly established trust, which would add value to the structure. Once again, with a sufficiently large amount of money, this could potentially be very worthwhile. Besides, it provides an excellent asset protection strategy. So, this second strategy would be as follows. Katie and Rod would set up a proper foreign non-grantor trust. Inside the trust, they would have a holding company incorporated in Cyprus or alternatively Malta, and the holding company would hold shares of the offshore company, which would be incorporated in Hong Kong. The main benefit of this structure is that we can avoid many US tax rules. As we've seen, a foreign non-grantor trust is a deferral vehicle that, if structured properly, could avoid the US CFC rules. This means that Katie and Rod wouldn't need to have their residency in the same place as the company's incorporation. Also, by definition of related parties, we would avoid transfer pricing studies for services. We would also avoid the GILTI tax. If we place the offshore company in a foreign non-grantor trust, Katie and Rod would not be able to benefit from the participation exemption, and the dividend income would not be considered a qualified dividend unless the foreign company is incorporated in a country with a double tax agreement. The problem is that the US does not have a wide range of tax treaties, and the countries it does have tax treaties with tend to have higher tax rates. Due to the limited options, we believe it would be better to introduce an additional holding company between the operating company and the trusts. This way, they could establish an operating company in a country with zero tax, which would pay no tax, and then have that company distribute tax-free dividends to a holding company with a double tax treaty with the US that does not impose a tax on dividend income. So, we would consider establishing a holding company in Cyprus, as it could be a good choice. Katie and Rod can pay themselves the salary from the Hong Kong company and take advantage of the foreign earned income exclusion in the US. The remaining profits could be directed to a holding company in Cyprus, where those dividends would not be taxed. Both Cyprus and Malta could serve as solutions for a holding company, but Cyprus may be slightly better due to its specific rules for taxing dividends, interest, and royalty income. So, Katie and Rod can receive profits from Hong Kong, keep the income in the holding company, and reinvest it. Banking options may be a concern depending on the amount to be invested, but some EU banks, such as those in Switzerland, could be an option. Now, to ensure we do not trigger a throwback tax if the US beneficiaries are involved, the best solution would be for beneficiaries to receive any distribution from the holding company as long-term capital gains income, which will be taxed at 20%. A foreign non-grantor trust can be set up in a jurisdiction like the Isle of Man or Jersey, where high-quality trustees, strong asset protection laws, and zero tax are available. Banking services for this could be obtained in Switzerland or other similar countries. Here, the team at Global Optimizer is available to make those introductions. So, based on the final decision Katie and Rod took, we can begin the action steps we talked about before relating to 1. Establish personal tax residency in a tax-free US state while living abroad. Move the Company A and Company C from California to a tax-free state. 3. Set up 2 Ding or Ning trusts for each son and gift each of them $10 million QSBS. 4. Transfer Company B into an S-Corp and relocate it out of California. 5. Establish foreign non-grantor trusts in the Isle of Man or Jersey. 6. Establish a holding company in Cyprus. 7. Establish an operational company in Hong Kong and set up banking in Singapore and Switzerland. Now, an overall fact we should be aware of. As Katie and Rod are US citizens, there is a threat that they will be taxed on their global income. They need to be aware that since they are American citizens, even though they will move out of the US and they will possibly obtain another residency, they are still obligated based on citizenship to file a US federal tax return each year if their total income, regardless of where the income was earned and in what currency, if it exceeds the minimum thresholds. In other words, they are subject to the same rules regarding income taxation as people living in the US stateside. But savings with our proposed strategy are significant compared to how they would be taxed under the current structure. So let's talk about the benefits. Benefits of the shift for Company A. Company A, a Californian C Corp, is subject to a 21% federal company tax rate. In addition, California imposes an 8.84% corporate income tax rate, bringing the total to almost 30% on the company side. On the personal side, the tax rate for withdrawals ranges between 10% to 37% at the federal level and 1% to 12.3% at the Californian state level, potentially resulting in a total tax rate of up to 49.3% on personal distributions. If dividends meet specific criteria and are treated as qualified dividends, they will be taxed at the lower long-term capital gains tax rate of 20% instead of an individual's ordinary income tax rate. Additionally, the Californian capital tax rate ranges from 1% to 12.3%, thus reducing the total tax up to 32.3% instead of 49.3%, but those are still high tax rates. In addition, gains made when selling the company will be subject to the same 20% capital gains tax rate, plus a Californian capital gain tax rate ranging from 1% to 12.3%. If the company relocates to a zero tax state in the US, it would save at least 8.84% and reduce company taxation to a 21% federal tax rate on the company level and up to 37% on personal income or 20% on the qualified dividends tax rate. If they follow a specific strategy and qualify for QSBS, they can also avoid the 20% capital gain tax at the time of selling the shares, resulting in a 21% company taxation and 20% on qualified dividends if any distribution is made until they decide to sell the company. So let's say in this case, the company's profit is $2 million. In the original state, they are subject to almost 30% corporate tax, including Californian taxation, on that amount, so it is around $600,000 in taxes. The remaining $1.4 million, if withdrawn to the owners, will be taxed at a long-term capital gains tax rate of 32.3%, including Californian taxation. So it is about $450,000 in taxes on a personal level. Also, when selling the company, they will be subject to capital gains from selling those shares, meaning a long-term capital gains tax of 32.3%, including Californian taxation. For example, if the gain they realized on selling the company is $20 million, the capital gain tax will be almost $6.5 million. Now, in this example, with our proposed strategy, they will be taxed at 21% on the company side, so that means only $420,000 in taxes. Also, the remaining $1.58 million will be taxed at a long-term capital gains tax of 20%. That means $316 in taxes. So, with just relocating to a zero tax state in the US, the savings are $150,000 on the corporate level and $134,000 on the personal level. So that is about $284,000 in savings per year. Over just the next 5 years, that would be about $1.42 million in savings. Also, if the company qualifies for QSBS, they will avoid capital gain tax at the time of selling the company, which will bring them an additional savings of $6.5 billion. Now, the benefits of the shift for Company B. Now, Company B, the LLC registered in California, is a pass-through entity, meaning there will not be taxation on a company level, only on a personal level. So they will be taxed up to 37% on the federal side and Californian income tax rates ranging from 1% to 12.3%. Or 20% capital gain tax rate and Californian capital gains tax ranging from 1% to 12.3%. If they follow our strategy and offshore this company to a zero tax country or a tax treaty country, they will be taxed at a reduced GILTI tax rate of 10.5%. And if held by a US C Corp, it will flow back to the US for a 20% long-term capital gains tax rate on dividends. However, if we add a trust and a holding company to it, we will avoid GILTI tax or throwback tax, so there would be no tax at the company level. However, if any distributions are made from the holding company within the trust to US beneficiaries, they would be subject to a 20% long-term capital gains tax rate. In the ideal world, no US beneficiaries would be involved, or they would renounce their citizenship and become tax residents of zero tax jurisdictions before the distribution. However, even with this strategy, Katie and Rod can use the benefits of deferral and reinvest their income in the trust. The benefits of deferral are significant. Besides, Katie and Rod can pay themselves a salary from the Hong Kong company and take advantage of the foreign earned income exclusion in the US. They will be exempt from $240,000 in salary income, which can be enough to cover their living expenses. Now let's go through a concrete example to explain the benefits between the original and the new state. So, in this example, the current company's profit is $200,000. As it is a pass-through entity, it will be taxed at progressive tax rates, which are 33.3%, 24% on the federal level and 9.3% on the Californian side. So that means it will be $66,600 in taxes. With the proposed strategy, if the company is incorporated in a zero tax country and placed in the trust, there will not be taxation on the corporate level and they will be able to use the opportunity of the deferral. Eventually, when the income is brought back to the US, it will be only taxed at 20% long-term capital gains tax, so it is a saving of at least 13% or $26,000 on the company profit without including the benefits of deferral, which I'll explain a bit later in a quick lesson. Even if the current company profit is not that big, once the company is offshored, they plan to expand the business and forward some of the income from the rest of the companies, so the savings will be significant. Now let's just do a quick tax deferral lesson, explaining the benefits of tax deferral. To illustrate just how significant this is, we'll use some fictitious and somewhat exaggerated math. Imagine you started with $1, and each period you doubled this $1, so at the end of the first period you had $2, and then $4, and then $8, and so on. At the end of 20 periods, you'd have $1,048,576. By contrast, imagine if instead of doubling after each period, you were taxed at a rate of 33%. So $1 doubles, and then the extra $1 raised is taxed at 33%, leaving you with $1.67, which then doubles again, but the $1.67 you added gets taxed at 33% again, and so on and so forth. If in the first scenario you'd have over $1 million at the end of 20 periods, how much would you have after the same 20 periods in the scenario net of tax? It would be reasonable to guess something around 670,000, right? So that's 1 million minus 33%, right? But in fact, the answer is much lower due to the power of compounding, or in this case, negative compounding. The answer is actually $28,466. Over $1 million less than you'd have in the first scenario. So this is a huge effect of tax deferral. So even if you let the money grow till the end tax deferred and you then paid 33% tax at the end of the first scenario, you'd have nearly 25 times more money in the tax deferred scenario than in the taxable scenario. These numbers of course are not believable because no one is going to double their money each period and no one will start with only $1. But this is just showing that the faster you compound the money, the more impact the powers of deferral will have. So here I just created a small illustration so you don't have to do the math yourself of what deferral means across different growth stages. So firstly, we have growing 100%. This was our original scenario. Obviously, it's very exaggerated, doesn't really make much sense. So next, we have growing at 9%. This is based on the average of the last 50 years of the MSCI World ETF. So from December 1969 to March 2024. This is what's seen as one of the most boring investments possible, just investing in global stocks. Super brain dead, everyone can do it. And even growing with this 9%, you can see here the difference after 20 periods, or in this case, after 20 years. The amount with deferral will become $5.60. So if we take that as 100%, the amount you earn without deferral is $3.23. So only 58% of the amount you would have earned with deferral. Now, if we were to go beyond the super boring 9%, let's say you have maybe some private investments or you're particularly good at investing, you might be working with figures such as 15% or 20% growth year over year. Then as the growth rate increases, the exponential effect of deferral becomes a lot bigger. So on 15% growth rate, being without deferral leaves you with only 41% of what you could have achieved. And for growing at 20%, you only earn 32% of what you could have achieved if you had deferral. So this is just a quick illustration of what it means to have tax deferral and the power of it. Alright, now that tax deferral was explained again, let's go back to the benefits of the shift for Company C. Company C is a Delaware C Corp, meaning it is subject to a 21% federal company tax rate and an 8.7% Delaware tax rate. Also, as Katie and Rod are Californian tax residents, they will be taxed at already explained federal plus Californian individual tax rates. However, if by our strategy, this company is relocated to a zero tax rate in the USA, its taxation will be reduced to a 21% federal tax rate on the company level and up to 37% on personal income or a 20% qualified dividends tax rate. Additionally, if the offshore company keeps providing services to this company and a part of the income flows to the offshore company, the taxable profit can be significantly reduced. The company's profit is $600,000. They are subject to almost 30% corporate tax, including Californian taxation on that amount. So it is around $180,000 in taxes. The remaining $420,000, if withdrawn to the owners, will be taxed at a long-term capital gains tax rate of 32.3%, including Californian taxation. So it is about $135,000 in taxes on a personal level. With our proposed strategy, they will be taxed at 21% on the company side, so that's $125,000 in taxes. The remaining $475,000 will be taxed at a long-term capital gains tax rate of 20%. So that means $100,000 in taxes. So with just relocating to a zero tax state in the US, the savings are $55,000 on the corporate level and $35,000 on the personal level. So that is about $90,000 in savings per year. Over the next 5 years, that would be about $450,000. Additionally, if they shift part of this income to the proposed offshore company and reduce company profit to, let's say, $200,000 instead of $600,000, they will pay $42,000 on the company level and $31,600 on a personal level. So the saving would be $138,000 on the corporate level and $135,000 on a personal level. So that is about $273,000 in savings per year. Over the next 5 years, that would be about $1.45 million. So putting this all together on one single slide so it's easier for you to see on one picture the before after for each of these companies, this is how it looks like. For each company, you can see here before on the left how much they would have had to pay previously versus afterwards on the right. And we can see here for company A, for 10 years, that's $2.84 million in immediate tax savings, as well as $6.5 million in savings on a potential sale, which they intend to do in the next 1 to 2 years. For company B, over the next 10 years, it's $260,000 in savings, as well as a deferral on $2 million in profit invested, which we will have explained previously on the power of tax deferral on investing. And finally, company C, over 10 years, it's $900,000 in savings or $2.73 million in savings if we, as suggested, shift some of the income to the offshore company, thus reducing the income from $600,000 for this company to $200,000. Now, the drawback of this strategy is that it is somewhat expensive to set up and maintain. Properly setting up a trust can cost up to $20,000 initially and maintaining it around $10,000 a year. Incorporating a holding company in Cyprus and operating it in Hong Kong shouldn't cost more than $5,000 to $10,000 in total. Now, I know this slide has a lot of information put together, so I'm going to show you this slide that condenses the benefits versus the costs. So you can see here on the slide on the left, company A, B, and C, their individual savings. We can condense this now to an overall savings of a tax savings per year of $400,000 plus deferral on $200,000 profit invested, as well as savings over 10 years of $4 million plus $6.5 million on sale, as well as deferral on $2 million profit invested. Now the cost to set up and maintain all of this is here on the right. Only $20,000 to set up the trust, $10,000 a year to maintain it, and $5,000 to $10,000 to incorporate the holding company in Cyprus and operating it in Hong Kong. As you can see here, the return on investment is insane now that the entrepreneur can control where his money goes. Alright, I know that was a very long case study breakdown, but I hope you enjoyed it and you can see the power of controlling where your money goes. Feel free to keep scrolling and look at the other case studies that we have on the page. But also, as if you want to start the journey to control where your money goes, or you might know someone who wants to do something similar, make sure to book a call with us and start your journey on helping you control where your money goes. Alright, bye bye now.